1-minute read: which car finance option should you choose? With around 80% of new UK cars purchased on finance, most buyers end up choosing between PCP, personal contract purchase, and hire purchase. But the two options work very differently, and picking the wrong one can cost you more than you expect. PCP keeps the monthly payments low because you only cover the car's depreciation, not its full value. At the end, you choose whether to pay the balloon payment, hand the car back, or move into a new deal. It offers flexibility and affordability, but mileage limits, condition charges, and the risk of ending up with zero equity make it less straightforward than it first appears. HP is far simpler. You spread the full cost of the car over fixed payments and automatically own it at the end. No mileage caps, no balloon payment, and fewer surprises, though the monthly payments are higher. Long-term owners and high-mileage drivers tend to get the best value with HP. Depreciation has become more unpredictable in recent years, especially for EVs, which affects how both PCP and HP behave, increasing the importance of knowing how much you drive, how long you keep your cars, and whether equity matters to you. Gap insurance is also worth considering for either option, given the rising risk of financial shortfalls in the first few years. Bottom line, PCP suits drivers who want low monthly payments and the freedom to change cars regularly. HP suits those who want simplicity, no mileage rules, and clear long-term ownership. The right choice depends not on the car, but on how you use it.